package. I'm joined by ING's economist Carsten Brzeski. He joins me live from Brussels. So, Carsten, what is this package likely to look like? How big is it going to be? And what kind of austerity measures are going to be attached to it?
It's going to be a very tricky one. I think in terms of the size, what we see now, it could be to have the size of the Irish program, so between 70 and 80 billion euro. That's the size. But what's going to be in this program is very hard, because Portugal does not have this one single outstanding issue like Ireland had the banking sector or Greece had the shadow economy. The biggest problem of the Portuguese economy is sluggish growth. So they need to find a program which actually balances fiscal austerity at the same time with promoting growth in the medium term. And that's a very tricky target or goal to achieve.
Does that mean it's going to focus on structural reforms, say, to the labor market?
I guess that's going to be it. I also think of this fantastic new pact for the Euro Plus, which the Germans have been putting forward. Increase competitiveness in the rest of Europe, also try to abolish wage indexation. There still is some wage indexation in Portugal, so I think this might be a bargaining chip for the Portuguese government, and it will exactly focus on the structural reforms to get growth back into the country.
As you say, this is going to be a difficult one. I mean, Portugal is about to increase its debt load by 60 to 80 billion, whatever the size of this package is. It already can't repay its debt. Why should the market be confident that it will be able to after this bailout?
That's a very tricky question. I think the market can only be confident if the bailout package really ensures that in the medium run, at least, so after a couple of years, the Portuguese economy is again able to grow. I think now over the last 10 years, average growth in Portugal is 0.7%. This is clearly too low. But if the program is constructed in such a way that the Portuguese economy can grow again, markets will also become confident.
Greece and Ireland, they saw their yields, their borrowing costs move higher or stay unsustainably high after their bailouts. Is the same thing going to happen to Portugal? I mean, doesn't that show that these bailouts aren't working?
Clearly, I think that this shows that there is still always one issue which the European leaders do not like to touch upon, and this is the issue of debt restructuring, and really checking whether the debt is really sustainable in the countries. This will only happen after 2013, but so far political leaders have refrained from checking this. And of course, this explains why yields have remained high. And they probably will remain high until European leaders really address the issue of debt restructuring and how they want to deal with it.
When you say address the issue, do you expect that Greece will default? What about Ireland and Portugal?
And the interesting thing here is that we see some kind of change in minds of at least European politicians, because there is rumor that they are now discussing actually the possibility of a haircut for Greece, of a debt restructuring for Greece. So we see some change in mind. It is really very tricky, and I'm not able to look into a politician's mind. They will have to make up their mind, especially the German government will have to make up its mind whether they are willing to swallow the bullet of debt restructuring, even if it could mean that German banks would need to have additional write-downs.
What's your view on contagion and whether or not we might see Spain be next?
I think there is no immediate risk of contagion, because yes, Spain is different. We heard the story, of course, that Portugal is different from Ireland, Ireland is different from Greece. Fair enough. I think the risk of an immediate contagion is very low, but still, Spain has at least two huge problems. One is the banking sector that we will have to need until we get the results of the EU stress test, and the other one is with the housing market bubble bursted, and unemployment at double-digit levels. I think Spain is looking into a rather dire economic future, which means growth will not be strong. And this means the government has to also balance fiscal austerity with very weak growth. And this is a tricky issue.
And now interest rates, of course, in the Eurozone are higher. But Linda Yu is just talking about how Trichet's signaled that perhaps they're going to be working on how they can help these addicted banks. What do we need from the ECB?
I have my doubts whether the ECB can really offer a lot. The ECB has already offered full allotment for a long while. The ECB even lowered the collateral rules for European government bonds. Really, I think the crucial thing is here whether governments are willing to recapitalize banks. This is the key here. It's not about the ECB. The ECB can only relieve the pain, but really, let's say the solution to the problem has to come from European governments.
All right, Carsten Brzeski from ING, thanks very much for being with us.